To the sell-off. Joining us now is Bob Elliott, CEO of Unlimited Funds, and Keith Lerner, the co-chief investment officer at Truist Wealth, along with CNBC's Christina Partsinevelos on the pain for tech we've seen, and Pippa Stevens on the plunge for crude oil and energy, Courtney Reagan on the move for retail stocks, and Diana Olick on one bright spot in the market, which has been the home builders. But first, we go to our market panel. Bob, I'm going to kick this off with you because it has been just a major flush out here for the market. How much further could we go, especially when you look at an S&P that has lost so much value here, 9% this week now, but is still arguably trading at multiples higher than what you'd expect with recession, despite what we're seeing in the bond market with the 10-year Treasury yield falling below 4%.
Yeah, when you scan across the markets right now, obviously the short-term market moves feel extremely large, and they are with any broader context. But the levels matter in terms of where we are in this market. And with PE still at 19 and bond yields still at 4%, none of this pricing looks like pricing in the sort of recession that would come if these tariffs remain in place for an extended period of time. And the reason why that is that basically everybody is betting on the fact that the new administration will roll back these tariffs in short order. If that doesn't happen, it means two things. One, a lot more pain for the U.S. economy and the consumer. And second, escalating retaliatory efforts abroad, kicking off a global trade war. And if that happens, you know, the moves that we've seen so far will look pretty modest in comparison to the wreckage that will come if those tariff policies persist.
Keith, what do you think about this market right now, especially given the fact that we did have a better than expected jobs report this morning, but investors seem to be looking through that. We had commentary from Fed Chair Powell in the middle of the day that, you know, continues to lean hawkish, and a number of other Fed officials as well. And then, of course, we continue to get these headlines, not only from Washington with the Trump administration and the back and forth with other countries, but also in terms of Congress and lawmakers and the fiscal part of this as things like tax policy begin to take shape, and perhaps maybe not as stimulative based on what we're getting in reports as had been previously expected.
Yeah, well, you just raised a lot of different points and a lot of things that this market is contending with. So our view is this, you know, back in February when we were closer to the highs, we downgraded stocks because there was a lot of complacency, and our work was suggesting there wasn't a lot of bad news priced in ahead of all this event risk. At least on a short-term basis, you know, we're still more neutral in our overall view, but we're telling our clients we would not be selling here today because at least the market is, at least on a short-term basis, starting to price in some of these uncertainties that you just raised. So we're down 17% from an all-time high. The typical recession is down around 24%. So effectively, you're pricing in about a 60% recession probability already. At the same time, you are seeing some things get a bit stretched. You're seeing, as mentioned earlier, put the call ratio spike, the VIX spike. I'm not saying this is the end, and I think we have a long slog ahead of us. But on a short-term basis, you know, I think yes, there's risk of more downside, but you're also at a point where a little bit of good news could go a long way as far as any type of movement on the tariffs at all. Again, longer term, I think this is going to take some time. But again, after two big down days, you know, at least the risk reward is a little bit more favorable than it had been when nothing was being priced into this market.